Today I'm going to share 15 dividend growth stocks to buy and hold forever. These are highly profitable companies that consistently pay a dividend, and they grow that dividend payment over time, often on an annual basis. They have a sustainable payout ratio so they can invest in future growth while continuing to grow the dividend over time. These are companies with a strong balance sheet and high free cash flow, and those earnings and cash flows continue to grow over time, and that's because these businesses have wide economic moats and clearly defined business models that work. And to find the stocks I'm going to share in this video, I used my stock screener over at dividenddata.com, and I specifically looked for companies in the United States that have at least a 0.5% dividend yield, a 5-year compound annual growth rate of the dividend over 10%, and a payout ratio below 60%. And the goal of this is to share 15 high-quality companies that will likely continue to grow their dividend at a high rate in the future. And by the way, if you want to use this stock screener and filter by hundreds of other financial metrics, or check out my AI stock research tool, and of course my full stock analysis tool as well, then sign up at dividenddata.com. And by the way, you can sign up and lock in 50% off for life. This is to celebrate the launch of my new AI investment analyst tool. Think of this as ChatGPT, but specifically designed for stock analysis. It's loaded with real-time financial data and documents, and there's a 30-day money-back guarantee, so no risk in trying it out. But let's get to the topic of the video. 15 dividend growth stocks to buy and hold forever. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. So as I mentioned at the beginning, I used my stock screener to find high growth and sustainable dividend companies. And I already went through many pages of this list and picked 15 companies that are worth sharing. And to start, I'm going to pick Microsoft, ticker symbol MSFT. This is the software giant we all know. It also is one of the 2 top stocks in my dividend growth stock portfolio. The company has seen a fantastic total return over the past decade, and the reason why is that they have had very high earnings per share growth in that time. Their 2 largest business segments, intelligent cloud and productivity and business processes, are both now high double-digit growth businesses. For productivity and business processes, that's that whole Microsoft 365 product suite. And over the past decade, they transitioned to a software as a service model, which makes it a subscription business. And a lot of that is enterprise revenue where they charge by seat. So they continue to grow as all of the corporations they serve grow in headcount. And then also over that time, a lot of software has transitioned to the cloud, with Microsoft Azure being the number 2 in that category behind Amazon Web Services. And you can see that as a percentage of revenue, intelligent cloud has continued to grow over time. Microsoft Cloud revenue is up 23% year over year, and that's led by Microsoft Azure. And specifically, AI is becoming a large part of that business, which is now up 60% year over year. And then they also use the advancements in AI to power all of their other products and services. Microsoft owns GitHub, which is the largest code repository, and they have a product, GitHub Copilot, which is basically to assist you in coding, and it's fantastic. And then you also have Copilot integrated throughout all of the Microsoft 365 bundle and products. Let's not forget they own LinkedIn too, which is now 6.7% of their revenue, and there really is so much more potentially tapped with LinkedIn. But the main point of me going into those business realities is to remind everyone that stocks are not just numbers and ticker symbols and prices going up and down. These are real businesses driving real value in the real world. And as they grow over time, their cash flows increase. For example, Microsoft's free cash flow per share has grown at an 11.95% 10-year compound annual growth rate, and this is only set to continue into the future. And Microsoft is able to use that free cash flow to return capital to shareholders. And one of the ways that happens is through their growing dividend payment. The Microsoft dividend is currently $3.32 per share. That's a 0.79% dividend yield at current prices. They pay every single quarter, and over the past 10 years, it's grown at a 10.35% compound annual growth rate. And this Microsoft dividend increase has happened every single year at 10% like clockwork. The payout is very sustainable too, at a 29% free cash flow based payout ratio and a 24% net income based payout ratio. So Microsoft has plenty of room to reinvest in their business while still growing their dividend payment. Another way they return capital to shareholders is through share repurchases. At Microsoft, this has been slower compared to peers like Apple, And frankly, that's because Microsoft has far better opportunities to reinvest and grow their own business and make acquisitions. And over time, this growth results in stock price appreciation. And this combination of total return is why Microsoft is a great dividend growth stock to buy and hold forever. But that's just my opinion and what I'm doing in my own portfolio. Now, I'm not going to be going through every single company in as much detail as Microsoft. We'll see though, it's early in the video. And I'm also not going to go in the exact order shown on this screener. So for stock number 2, I'm going to do United Health Group, ticker symbol UNH, the number one healthcare provider in the United States. This is not a stock I personally own, but I would do very well if I had invested in it. As you can see, the past decade has been very good for UNH, and that has been fueled by high earnings per share growth in that time. Revenue has grown at a 12.5% 10-year compound annual growth rate. Net income per share has grown at a 15.7% 10-year CAGR. Free cash flow per share has grown at a 16.92% 10-year CAGR. However, it should be noted, now that I'm looking at the trend of their financials, free cash flow per share should come down for the full year fiscal 2024. They are underperforming 2023 by a sizable amount so far, but Q4 has not yet reported for them. However, this long-term growth in free cash flow has led to a fast-growing dividend payment, while also having a more significant dividend yield compared to companies like Microsoft. The current dividend payment for UNH is $8.40 per share. That's a 1.36% dividend yield at current prices. It is a very sustainable quarterly payer, and the 10-year compound annual growth rate of the dividend is 18.8%. It should be noted that this has slowed down with a 13.14% 3-year CAGR, and the most recent increase was 11.7%. If we look at the payout ratio, it's sustainable based on both free cash flow and net income with 26% and 30% respectively. The stock is trading at a relatively high valuation though, and is currently at its all-time high in stock price. However, the company is not that overvalued because they're expected to have very high growth and earnings per share in the coming years. For stock number 3, I'm going to share Visa, ticker symbol V. This is a fast-growing digital payments company, the number one stock in my dividend growth portfolio ahead of Microsoft. People may think of Visa as the credit or debit card company, but what they really do is operate a digital payment network, but they don't actually issue cards themselves or bear any direct credit risk. They operate the network, secure payments. They make their money through fees from data processing, from services they offer to the financial institutions, which are the ones that issue the cards, and international transaction fees such as cross-border payments. And Visa has had a fantastic business model benefiting from the transition to digital payments. The earnings per share has grown a large amount over the past 2 decades, and the stock price has followed suit ever since going public in 2006. Revenue per share has grown at 13.5% 10-year compound annual growth rate. Free cash flow per share has grown at 13.44% 10-year CAGR. And the thing with Visa is they are a very high margin business. They have 77% gross margins and 55% net margins, and they require very little capital expenditures in order to grow their business. For example, their operating cash flow has grown from $6.5 billion to $19.9 billion over the past decade. But in that time, capital expenditures have only grown from $400 million to $1.2 billion. So this has led to an explosion in free cash flow, which gets returned to shareholders via dividend payments and share repurchases. The Visa dividend has grown at a 17.26% 10-year compound annual growth rate. The most recent increase was 13.46%, which is a slight slowdown, and that's likely from fiscal 2024 being slightly down. The current annual dividend payment for Visa is $2.36, and based on the current stock price, the dividend yield is 0.77%. This is a quarterly payment, which is very sustainable. Payout ratio based on free cash flow is 22.56%, and based on net income is 21.36%. And Visa actually returns far more capital to shareholders via stock repurchases than dividends. That results in the shares outstanding declining by 2 to 3% a year. With stock number 4, we have Mastercard, ticker symbol MA. And what I just said about Visa, almost all of it applies to Mastercard. This is basically Visa's little brother. They have practically the exact same business model. They are a duopoly which both operate the 2 biggest digital payment networks. And again, the financials have been fantastic over at Mastercard. Revenue per share has grown at a 10-year compound annual growth rate of 14.45%. Free cash flow per share has grown at 14.5% 10-year CAGR. The Mastercard dividend is currently $2.64 per share with a 0.5% starting dividend yield. It's a quarterly payer which grows on an annual basis. The 10-year CAGR of the dividend is 19.62%. The most recent dividend increase was 15.79%. The Mastercard dividend is very sustainable at an 18.5% free cash flow payout ratio and 19.2% net income payout ratio. And again, they also buy back a very large amount of shares. And this combination makes Mastercard a great dividend growth stock. And over the long term, I might add it to my portfolio in addition to Visa. For stock number 5, I have the Home Depot Depot, ticker symbol HD. This is the famous home improvement retailer, one of the biggest retailers in the United States. They have a great brand, and Home Depot and Lowe's have a very dominant position. And over the past decade, this has been a great performer. Revenue per share is growing at a 10.7% 10-year CAGR, and free cash flow per share is growing at a 15.16% 10-year CAGR. And the Home Depot is the highest yield dividend payment I have shared so far. The current dividend yield is 2.2%, and the annual dividend is $9 per share. The dividend has grown at a 16.9% 10-year CAGR. However, this has slowed down, with the 3-year compound annual growth rate being 10.8%, and the most recent dividend increase was 7.6%. So this is signaling a continued slowdown in the Home Depot dividend growth. And the reason why is that since 2022, you have seen a slight decline in earnings per share. The current payout ratio for Home Depot stock is 46.71% based on free cash flow and 55% based on earnings per share. This is another company where they repurchase shares at a very high rate. Financially speaking, one of the main negatives for Home Depot is they do have a large debt position. This is actually far worse at their peer Lowe's, which I will soon explain, but this does seem to be a common thing in a lot of brick and mortar retail companies. Stock number 6 is American Express Company, ticker symbol AXP. Now, American Express is a credit card company, and they do issue cards themselves, so they do bear that risk, but they also operate on their own payment rails, so they do share some of those economics to Visa and Mastercard. And just to highlight that, I did ask Dividend Data about the key differences between American Express compared to Visa and Mastercard's business, and these are actually some pretty interesting differences. They charge net card fees, which generates subscription-like revenue from annual fees on their premium card products, so that seems like a pretty nice business. And the revenue for that stream grew 18% year over year in Q3 2024. And as I mentioned, they actually are the credit card company, so they earn interest revenue from lending to customers. That grew 17% year over year in Q3 2024. And American Express stock has just boomed over the past year. It's had a very impressive run, and it's making me think that it was actually pretty undervalued for a period of time. And over the long run, they've had a great track record of earnings per share growth, although it is pretty notable that with this stock, they see a massive drop off anytime there's a financial crisis. And this is an impact to their earnings, not just their stock price. You can see in 2001, in the great financial crisis following 2008, and in the COVID pandemic 2020, big drop offs to their business. And this is a far more dramatic drop off compared to Visa and Mastercard. However, that can create buying opportunities. Look how cheap American Express stock got during 2009. If you bought any time during that 3-year chunk, that would have been a great return on investment. And any time during 2020 would have been a great buy. I should have had my eye on this stock. Revenue per share is growing at a 10.4% 10-year compound annual growth rate. Free cash flow per share is growing at a 12.74% 10-year CAGR. The American Express dividend has grown at a 10.4% 10-year CAGR. This has accelerated in recent years with a 17.64% 3-year CAGR. The current annual dividend payment is $2.80, which makes it a 0.97% dividend yield at current prices. The most recent dividend increase was 16.67%, and the payment is very sustainable with a 10% payout ratio based on free cash flow and a 21% payout ratio based on net income. American Express also buys back shares consistently at a high rate. For stock number 7, we have Intuit, ticker symbol INTU. Also, I just want to emphasize that throughout this whole video, I'm using my stock research tool, dividenddata.com, and I really do think it's the best tool on the market right now, especially since we just launched our new AI chat feature. This is something all the other websites do not have, and I think it's a great time to try out dividenddata.com. That's why we're doing our 50% off sale. So use the promo code AI at checkout if you sign up via the web app, or click the link in the description and pin comment to sign up and get 50% off for life. Back to the stock analysis. So Intuit's a software company that has seen fantastic growth over the past decade plus. They own a portfolio of high quality software businesses, including TurboTax, Credit Karma, QuickBooks, and MailChimp. Many of these are leading in their respective category. Revenue per share is growing at a 5-year compound annual growth rate of 17.39%. Free cash flow is growing at a 5-year CAGR of 14.68%, and that is with it going down 2% over the past year. And ever since the company started their dividend payment in 2011, they have been an annual dividend growth stock. The 10-year CAGR of the dividend is 15.32%. The most recent dividend increase is 15.56%, and with an annual dividend payment of $4.16, and with the current stock price, the dividend yield is 0.61%. The free cash flow based payout ratio is 22.31%, and the earnings per share based payout ratio is 34.9%, this is very sustainable. And historically, Intuit has bought back shares at a high rate, but they have stopped really since 2016. And during that time, shares outstanding have actually slightly grown. But Intuit is a high gross margin software business that will likely continue to grow in the future. The main risk with Intuit is that for some reason, the US changes their tax system to something that's like way simpler. And then potentially that could reduce the need for their software product TurboTax, which is their main moneymaker. And you can see once a year, they have these massive spikes. That's from tax season when TurboTax makes all its money. But at this point, that's just speculation to worry about. For stock number 8, I'm going to share the Hershey Company, ticker symbol HSY. This is a higher yielding stock than many of the ones I'm sharing today, and they have had a large sell-off as of late. But Hershey is a company which, in my opinion, owns some of the highest quality candy brands in the world. That includes Hershey's, Reese's, Kit Kats, etc. I would suggest you go through their entire brand list and you'll see it's like a large chunk of the grocery store. And prior to the sell-off, the company had strong long-term performance, and they have had a slight decline recently in earnings per share. Revenue per share has grown at a 5.52% 10-year CAGR. However, this has accelerated with the 5-year CAGR being 8%. Free cash flow per share has grown at a 7.33% 10-year CAGR. And the Hershey dividend has had rapid growth in recent history, and in my opinion, got a little ahead of itself. They broke their pattern and had 2 increases within the past year. That was a 14.93% increase and a 15% increase within 2 quarters of each other. Historically speaking, the 10-year compound annual growth rate of Hershey's dividend is 9.86%, but those 2 recent increases boosted their annual dividend payment to $5.48. Current dividend yield is now 3.12% after the sell-off. So 3.21% is potentially a great buying opportunity for a high-quality, long-term dividend growth stock. The payout ratio is sustainable too, at a 57% free cash flow-based payout ratio and 47% net income-based payout ratio. And this actually is the highest starting dividend yield for Hershey stock over the past decade. And if we go farther back, this is the highest starting dividend yield since the Great Financial Crisis. So potentially this could be a really great buying opportunity for Hershey stock. Let me know in the comments if you want a full stock review video on Hershey, because I'm pretty sure they just reported earnings too. I may end up doing it anyways, so be prepared for that. Stock number 9 is Snap-on Incorporated, ticker symbol SNA. This is a tool company I have covered recently on the channel. Their stock price has boomed as of late, and I was eyeballing it to add to my portfolio, and now I'm a little worried that I missed the boat there for a bit, but I'll keep my eye on it. Coming out of 2010, the company has seen massive and consistent earnings per share growth. Free cash flow per share has grown at a 5-year compound annual growth rate of 16.9%. The Snap-on dividend has grown at a 15.51% 10-year CAGR. The most recent dividend increase was 14.81%, and the current annual dividend is $7.44 per share. At today's stock price, that gives it a 2.07% dividend yield, and this is a sustainable dividend payer too, with a 33% free cash flow based payout ratio and 35% EPS based payout ratio. Stock number 10 is Lowe's Companies, ticker symbol LOW. This stock has done fantastic over the long term. However, similar to Home Depot, it has seen a decline in earnings per share since 2022. And based on this trend in the broader economy, I'm assuming it's because of a slowdown in home renovations and spending on people's homes, less construction, new projects, etc. For Lowe's, revenue per share has grown at an 11.4% 10-year CAGR. Free cash flow has grown at a 13.4% 10-year CAGR. However, it is important to note that free cash flow per share has declined since fiscal 2021. But so far in the current fiscal year, both Q1 and Q2 have outperformed, so they're likely on their way to their highest free cash flow per share yet. If you just add up Q1 and Q2, they're already at the highest ever. And likewise, dividend growth did slow down for a period of time to reflect that change. The 10-year compound annual growth rate for the Lowe's dividend is 17.46%. The 2 most recent increases, however, were only 4.5% and 4.7%. And again, that was likely from their slowdown of earnings and free cash flow. The current annual dividend payment is $4.60, and with today's stock price, that's a 1.7% dividend yield. And the payout ratio is still very sustainable at a 40% free cash flow payout ratio and 32% EPS payout ratio. And this will go down a lot given their increase in free cash flow for this coming year. This is also a company which bought back a ridiculous amount of stock. I'm talking they had years where they were buying 7 and 9% of their shares outstanding, and a lot of this was done with debt. You can see their liabilities just explode, and now they have $35 billion in net debt. So this is just something to be aware of if you're investing in Lowe's. For stock number 11, we have Applied Materials, ticker symbol AMAT. This is a semiconductor technology company specifically focused around the manufacturing equipment that's used in these fabrication plants, and this has seen tremendous earnings per share growth since 2016. However, it should be noted that the semiconductor sector does go through lots of boom and bust cycles, and you can see that reflected in their long-term earnings per share. So that is a risk about investing in Applied Materials. You might have to time a good entry point. However, over the long-term growth has been tremendous. The 10-year CAGR of revenue per share is 17.5%, and the 10-year compound annual growth rate of free cash flow per share has been 38%. And this is less of a consistent dividend growth stock. As you can see, they paused from 2013 to 2018. However, since then, they have continued annual dividend growth, and that has accelerated. The 3-year compound annual growth rate of the dividend is 18.56%. The most recent increase was 25%, and the current annual dividend is $1.60 per share. And at current prices, it's a 0.83% dividend yield. But here's the kicker. The payout ratio is super low. Based on free cash flow, they have a 12.8% free cash flow based payout ratio. And based on net income, that's 14.22%. This company generates a lot of free cash flow and actually has a reasonable valuation. I should also mention that they do consistently repurchase stock, and in recent years, this has been as much as 3 to 4% a year. Stock number 12 is Nike, ticker symbol NKE. This is another stock that has seen a significant sell-off. The current price per share is $75.88, which is a far cry away from their all-time high stock price of $177 per share. And you can contribute a lot of that to their slowdown in growth in earnings per share and likely increased competition as well. And I haven't been following the space closely, but I know they are facing increased competition in the athleisure wear sector. And I have heard that's because they shifted so much online during the pandemic, they let a lot of shelf space and potential competitors fill that void. So a little bit of market insights there. But I would reiterate that in my opinion, Nike is still a very strong brand that will be around for a long time to come, and they definitely are a dividend growth stock. Revenue per share has grown at 7.89% 10-year CAGR, and free cash flow per share has grown at 13.6% 10-year CAGR. The Nike dividend has grown at a 10-year CAGR of 11.92%. This has slowed down slightly, with the most recent increase being 8.82%. This growth makes the current annual dividend payment $1.48 per share, and with this fall in stock price, the current dividend yield is 1.95%. And this by far is the highest dividend yield for Nike stock over the past decade. And this is the highest dividend yield you can buy the company at since the great financial crisis. And Nike's not in bad financial situation either. The dividend payment is a 32% payout ratio based on free cash flow and 38% based on net income. They still buy back stock too, with 2.5% a year. They still buy back stock too, recently hitting 2.5% a year. So if you're a long-term dividend growth investor and interested in Nike stock, this may be a good buying opportunity. Certainly the best opportunity in the past 5 years. For stock number 13, we have Automatic Data Processing, ticker symbol ADP. This is one of the newer and smaller positions in my dividend growth stock portfolio, but what I like about them is a large part of their business. But what I like about them is that they are now a subscription software as a service company. And for the most part, they grow as their customers grow. Revenue per share has grown at a 10-year CAGR of 6.5%. This has accelerated over the past 3 years at 9.9%. Free cash flow per share has grown at a 10-year CAGR of 11.1%. And they did decline less than 1% over the past year, but that followed up annual growth of 44%. ADP has a nice combination of dividend yield and dividend growth. The current annual dividend payment is $6.16 per share. At current prices, that's a 2.02% dividend yield. The 10-year compound annual growth rate of the dividend is 12.13%. The 3-year CAGR of the dividend is 13.98%. The most recent dividend increase was 12%. And this is a company which has consistently, year after year, grown the dividend for decades. The current payout ratio based on free cash flow is 60% and 58% based on net income. So the dividend payment is sustainable and will likely continue growing well into the future. Stock number 4 is Deere & Company, ticker symbol DE, the maker of the famous brand John Deere. And coming out of 2020, they had fantastic growth, which has since stalled, and this is directly reflected from their massive growth in earnings per share and then stalling out a little bit over the past year and a half. Revenue per share has grown at a 10-year CAGR of 7.91% and 3-year CAGR of 23%. Free cash flow per share has grown at a 19.98% 10-year CAGR, and you would definitely throw the John Deere dividend in that dividend growth category, although their increases are quite quite sporadic. You can see that since coming out of 2020, they just had a lot of dividend increases at very different frequencies, but ultimately that gave them a 5-year CAGR of 14.1%. The current annual dividend is $5.88 per share. And at the current stock price, that's a 1.49% dividend yield. The dividend is sustainable too, with a current payout ratio based on free cash flow of 34%. And based on earnings per share, they are always very sustainable, with the current one as low as 14%. And wrapping up the list, as stock number 15, I have the Kroger company, ticker symbol KR. This is the grocery conglomerate owning many different grocery store chains, including their leading brand, Kroger. And this has a long history of success with very solid earnings per share growth over the past decade. Revenue per share has grown at an 8% 10-year compound annual growth rate. Free cash flow per share has grown at a 15% 10-year CAGR. However, it should be noted they have not yet reached those 2021 highs of free cash flow per share yet. And during that time, this stock was deeply undervalued, and I actually bought my position then. The Kroger dividend has grown at a 13.2% 10-year compound annual growth rate. The annual dividend payment is $1.28 per share. The most recent dividend increase was 10.3%. The annual dividend is $1.28 per share, and at the current stock price, that's a 2.14% dividend yield. So again, a good combination of starting dividend yield with dividend growth. The current payout ratio based on free cash flow is 26.7% and 36% based on earnings per share. The company also returns capital to shareholders via share repurchases. However, this has slowed down over the past year. So those are 15 dividend growth stocks that you can buy and hold forever. And again, if you want to use my stock research tool, sign up at dividenddata.com. There you can get access to my advanced stock screener and filter by hundreds of possible financial metrics. I want to reiterate, this is very useful. You can also ask Dividend Data, my AI chat tool, really anything you want about investing. And it's specifically trained to understand stock analysis. And then of course you get my full stock analysis tool on top of that. And now is the best time to join because I'm doing a 50% off sale to celebrate the launch of my new AI tool. If you join via the web app, then add the promo code AI, that's the 2 letters AI, at checkout to get 50% off, or click the link in the description and pinned comment to get the sale directly. Now is the best time to join, and I want as many of you to try this out as possible. Also, if you enjoyed the video, leave a like and subscribe to the channel. Let me know in the comments if you want to see more videos like this or a specific video drilling down into any of the stocks I mentioned today. Thanks for watching.